Welcome to Ride-On Academia. Today we are going to be looking at the ledger account. All right. Now our ledger is a principal book of accounts where we post transaction from the journal entries. All right. In our previous videos, we have looked at the journal. We have looked at the subsidiary books. So our ledger, literally, transactions are posted from our subsidiary book to our ledger account. Okay. Now one special thing about our ledger is that our ledger follows the rules of double entry. Yes, this is the rule that guides our ledger. Okay, the principle of double entry. Now the principle of double entry holds that for every debit transaction there is a credit transaction. Now I'm going to be giving us a format of the ledger so that we are together. All right, this is our ledger format, our credit side and our debit side. All right, we have our date, particular, our folio and amount, and same side. Alright, so this is our ledger format, right? Where we have our date, particular. Now we can see that there is a divider. Alright, this is what we call a divider. The central line is our divider. Okay, it separates our debit side from our credit side. Okay, so our ledger follows the principle of double entry, like we were saying. The double entry principle was that for every debit transaction there is a corresponding credit transaction, and then it also holds that every transaction must affect two accounts. Okay, two accounts must be affected in our ledger. All right, where one account is debited and the other account is what, credited. Now we'll be looking at the different type of ledger account, or if I will call them categories of our ledger account. All right. Now this is our ledger account. All right. Our ledger can be classified into four. Okay, we have our debtors ledger. It's also known as trade receivables. Okay, our debtors or trade receivables ledger. We have our creditors. Or our trade payables. Right? Then we have our private ledger. And then lastly, we have our general ledger. Okay, so these are the broad categories we have for the ledger account. Okay, now our debtors ledger here, it records all the transactions that has to do with people who are owing us money. That's why it is called trade receivables. Everybody that is owing the business money is the debtor to the business. So all their details are registered or recorded in the debtors ledger. All right, everybody that owes the business money. Now the creditors refer to those who the business is owing. Okay, in this case it is we that are owing the creditors. Okay, they could be our suppliers or people who have rendered maybe once. In fact, basically they are the suppliers of companies' products, those who the business buys from on credit. They are the creditors, and they also call them the trade payables. Okay, all the information relating to them is recorded in the creditors ledger. Then we have the private ledger. Now the private ledger deals with the proprietor. Okay, the proprietor contributes capital. The proprietor can also withdraw from the business, which we looked at as drawings. Okay, when the proprietor withdraws from the business, it is called drawings, right? And every information that has to or that relates to the activities of the proprietor in the business, if he is bringing money into the business, which we know as capital, or if he's taking money out of the business, which is called drawings, or he can take money out or goods out. Okay, they are all recorded in our private ledger. Now our general ledger records every other transaction in the business that does not relate to persons. Okay, this relates to person. Okay, every other transaction that do not relate to person are recorded in our general ledger. Now our general ledger can be further subdivided into the real and nominal. Okay, Now, the real has to do with assets, like fixed tangible assets that you can feel, you can carry about, okay? Where we say furniture and fitting, where we say motor vehicle, those information are recorded in the real assets, on the real ledger account, okay? In our real account. Then our nominal record other expenses. Alright, expenses that were not really on tangible things. Expenses like maybe electricity bill, salaries, we get it, and then maybe other income that was received, your sales, your purchases, all those other activities or transactions are recorded in our nominal ledger. Alright, this is our format. Now, in further simplifying our ledger, I'll be classifying all our transactions into 5 major categories for us, in order to help us understand how to post to our ledger account, okay? How do we post? What are the formats? What are the rules that we can apply in posting to the ledger account? So I'm going to classify transactions into 5 major categories. Now we have capital, we have assets, we have liabilities, we have income, and lastly expenses. So every transaction in the business can be broadly classified into these 5 components, and then these 5 components have their various rules in entry, okay? Now when we have a capital account in our ledger and we want to post, the increase in capital, okay, the increase in capital is credited. This is one thing we must know. At least this principle will help in a long way in accounting, alright? Every time our capital increases, we enter on the credit side, okay? The credit side refers to this side, the other side, okay? We enter on the credit side, and every time there's a decrease in capital, which many times don't really happen, but if there's a decrease in capital, then we enter on the debit side, alright? Good. Now the next one we are having is our assets. Now our assets are the resources that the business owns, right? Everything that the business owns. We have both non-current assets, we have current assets, okay? Now when there's an increase in assets, increase in our assets is debited, and then decrease, you can see now that there's an exchange. Increase here was credited, whereas for assets, increase is debited, okay? And then decrease in asset is credited. Now we have our liabilities. Our liability follow the same principle with our capital, okay? Increase in liability is credited, and the decrease is debited, okay? Now our income follows the same principle with our capital and liabilities. So an increase is credited and a decrease is debited. And lastly, our expenses follow the same rule with our asset, okay? So our increase in expenses is debited, and a decrease in expenses is credited. So when we identify of any transaction at all, we begin to ask ourselves the first question: is it a capital? Is it an asset? Is it a liability? Is it an income and expenditure? So if we are able to identify which category, the next thing we ask ourselves if there's an increase or a decrease, and then we apply this rule. This will help us basically in posting, okay? And that was why the accounting information states that asset is equal to capital plus liability, okay? Because capital and liability, as you can see, they follow the same format. Now I'm going to be bringing another classification. We can now merge our asset and expenses together since they follow the same rule, okay? For increase and decrease, we are having debit, and then decrease, we are crediting, all right? Then we can be merging our capital, our liabilities, and our income, because in an increase they are credited, and then in decrease they are what? Debited. Now with this, we are going to be taking transaction. Like I said, in our ledger we follow the principle of double entry. That means every transaction must be entered twice in the principal book of account, okay? It must be entered twice, okay? So we're going to be taking examples of transaction, and then we'll be entering it into the relevant account. Now we have that on the 7th of February 2011, on 7th of February 2011, there was a cash sale of 400 naira. Okay, now let's quickly write that. We have 7th February 2011 cash sales. This is a transaction that was given. So how do we enter this in the ledger account? The first thing we need to do here is to identify, like I said, the ledger works with the principle of double entry. We're going to be identifying which two accounts can with this transaction be affecting. Okay, if there was cash sales, it means goods are going out, right? We are selling, goods are going out, and then we are receiving money in return. So there's an increase in sales volume. The rate of sales is increasing, right? And then at the same time, the money that we have received is also what's increasing. So we have sales accounts here, and then we have cash account. These two accounts are affected because as we're selling, we're receiving money. That's why it is called cash sale. That means there was an immediate payment. Okay, now we're going to look, is our sales increasing? Yes. And our cash increasing? Yes, right? Our cash is increasing, our sales is increasing. The first thing we're going to be doing now is to identify what category, like I just did the categorization of accounts, right? What categories of account do sales belong in? Now, our sales belong in income, all right? The source of income for the business. Sales belong in our income, and then cash belong to assets. This is its category. So we follow the rule for income, all right? So an increase in income is what? Credited. And an increase in our asset is what? Debited. As you can see, if we have applied the categorical law correctly, then we'll be having a credit and a debit, okay? And that is the principle of our what? Double entry. So we'll be posting for sales and cash, okay? Since we have gotten our categories correctly and our entry side, we can now open our sales account, okay? Our sales account. This is our credit side and our debit side. Now, following the same format, all right, you can either leave it in your T format or rule it out nicely like I did. Okay, so I'm going to be using my T format. The first thing I'll be entering is our date. Okay, on the credit side, we have. Okay, now we're going to be entering for. Okay, our particular here will be entering for the reference account, that is folio, right? What we'll be entering here will be entering in cash. Okay, because this transaction was carried out, the sales was done in cash. Okay, it was a cash sale, so we'll be entering in cash, okay, of how much? 400 naira. This is it. We have entered in our sales. This is our sales account. Okay, then the next thing we'll be doing, like our double entry states that this transaction must affect two accounts. So we just identified one of the accounts. Okay, the second account to identify is our cash account. So still using my T format, right? Now, like I said, we are debiting for assets. So we'll be entering on the debit side. Our date is on the 7th, same date, 2011. Now we'll be entering as what? Sales, because this money was received from sales. Okay, was received from the sales of goods for how much? 400 naira. As you can see, this account was credited and this was debited. So you can say we have successfully posted this transaction into the ledgers. All right, now the next transaction we're going to be looking at is that on the 8th of the same February, okay, on the 8th of the same February 2011, wages were paid for 600 naira cash. All right, so wages were paid. Now we're going to be entering that. We are through with this now. Okay, we are going to be entering that on the 8th of February. So we paid wages. Now, wages were paid by cash. So like I said, the first thing to do is to try to identify which two accounts. Like I said, since we are following double entry, meaning every transaction must affect two accounts. Okay, it's what we have to just know is sure. All right, that's why it is called double entry. It must affect two accounts. So we now have to look at what two accounts are affected here. Okay, now we are paying wages, so there's a wages account, right? And then we are paying by cash, so we also have cash account. So I'll be bringing out our wages and our cash. Good. Now the next thing is to identify what categories do they both belong in. All right. Now wages belong in expenditure, and then our cash is still a current asset, right? Now we're going to look at, now we have gotten that. Now is our wages increasing or decreasing? All right, in this case our wages account is increasing because our workers are receiving more. Okay, so our wages account is increasing. It's an increase here. And then as we are paying in cash, cash is decreasing, cash is leaving the business. Okay, so there's a decrease here. Now we have to apply the rule. Now I said that our expenditure and asset follows the same category, right? So an increase in expenditure will be debited, while a decrease in assets, they follow the same rule. A decrease in assets will be what? Credited. Okay, so a decrease in assets will be credited. And now we have seen that we have gotten our principle for what? Double entry. Now if you can see, we already have a cash account on the board. We already have a cash account, so I will not be opening another cash account. We're making use of this same cash account, right? So entering in for our cash, since there is a decrease, we are crediting now. The date is on the 8th of February 2011. We have what? Wages. Okay, the expenses was done on wages, and the amount was what? 600 naira. Good. And then the next, if you go to our wages account, right? We move to our wages account. So there's an increase in our wages. Our workers are receiving more money, right? So we can say there's an increase in our wages. We'll be debiting for wages on the 8th of February 2011. We have what? Cash, because they received cash, right, of 600 naira. We see we have successfully entered for this. Now we're going to our next transaction. We have, again, we have sold goods to Mr. John by cash. Sold goods to Mr. John by cash, 800 naira. We sold goods to Mr. John, but I think we have something similar on the board already. Our sales and cash account, right? We sold goods to Mr. John. Now, because it was a cash sales, we will not be taking into consideration the name Mr. John. All right. Now, because it was a cash sales, we will not be taking into account the name Mr. John. But assuming it was a credit sale, that is, if we did not collect cash, okay, we will have to be considering Mr. John as a debtor, okay, meaning he was buying on credit, he didn't pay. So we are going to be taking Mr. John and sales accounts. But because it is a cash sales, we no longer be considering his name, okay, because we have no business, we have no record of debt with him. All right, he paid us, and then we have nothing, or he has nothing on us, and then we have nothing on him too. Okay, so we're going to be looking at our sales account and our what? Cash account, because he paid immediately. So our sales was increasing and our cash was also increasing. So we just entered in for our sales account on the 8th, right? Was it 8th? Let's get our date. Right. Okay, on the 10th, sorry. On the 10th of February 2011. So we have what? Cash. A cash sales of 800 naira. And then we come to our cash account on the 10th of February 2011. We have sales of 800 naira. Alright. Now I'm going to be entering for the next transaction we have. Now we have that on the 12th of February 2011, we sold goods to Mr. Oko 400 naira. Now in this case, cash was no longer indicated, like we sold goods by cash. All right, we sold goods to Mr. Oko 400 naira. It means, okay, 12. Good. In this case, we're not told that we sold goods to Mr. Oko by cash anymore. We're just told that we sold goods to Mr. Oko. It means he didn't pay immediately, okay? Maybe the payment was delayed to a later date. That means Mr. Oko at this point becomes a debtor to the business. Now, since he's a debtor to the business, we're going to be opening an account for him, alright, to keep track. The reason why we open account majorly is to be able to avoid or to be able to attend to any disagreement that may arise in the future. Maybe somebody can say I did not or I did or something like that. We're able to keep track of this transaction, that this actually happened on this particular date at this particular time, or this was what you bought, like that. So that's why we keep record, okay? Now, since he is a debtor, because now he's owning the business, right? So he's a debtor to the business. We're going to be keeping a record for him, okay? So our sales is still increasing, and this time around our debtors, which is Mr. Oko, okay, is a debtor to the business in this case because he's owing us, right? So this is a debtor, and debtor is still an asset, right? So increase in debt, okay, is debited following the asset rule, right? And then for our sales, increase in sales is credited. We are already used to that. Now, like I said, since we already have a sales account on the board, we will no longer be opening another sales account. We're making use of what we have, all right? So our increase in sales, okay, we'll be having that on the 12th of February 2011. Now, we did not receive cash, okay, but we know that our money is with who? Mr. Oko is owing us. So his name will be coming here, Mr. Oko, all right? And then the amount is what? 400 naira. Now we also have to open another account. If you can see the board, there's no Mr. Oko's account here, right? So we'll be opening an account for Mr. Oko. I'll be using here. So for Mr. Oko, he's a debtor, and a debtor is an asset, right? It's an asset to the business, a current asset. So there was an increase in debt, so we'll be entering in on the debit side for Mr. Oko, okay? Our date is what? 12th February 2011. So he became our debt on account of sales, okay? So we'll be having sales of 400 naira. Alright. Now let's see if we can get one more example. Yes, we have on the 14th of February 2011, we have cash withdrawn from the business for personal use, okay? That is, the proprietor was withdrawing for his own use. So cash withdrawn from the business for personal use to be 150. All right. Now let's see. So we have cash withdrawn. Okay, cash withdrawn by the proprietor. Alright, so we have cash that was withdrawn from the business by the proprietor, okay, for personal use to be 150 naira. Alright, so like we said, still on our principle of double entry, we have to identify the two accounts in this transaction that will be affected. Now, cash was withdrawn, okay, money was taken from the business. That means our cash will be reducing, the money in the business will be reducing, right? And then our proprietor here stands for the owner of the business, okay, he was one that withdrew. So since he withdrew, like I said, whenever the owner of the business take out money from the business, it's called drawings, okay, that's called drawings. Now, but if you are taking that money for a best, maybe you are taking the cash and paid into the bank, or from the bank and brought to the business use, then you would have followed that contract entry. It would have not been a drawing, okay? Now, he took it for personal use, so we are having cash accounts and we are having our drawings account. Now, drawings account is under the private ledger, okay? Under the private ledger, it will be affecting our capital. Like I said, a decrease in capital will be debited, okay? This is going to be affecting our capital. So a decrease, whenever the owner drawings affects capital, all right? A decrease in capital will be what? Debited. Since an increase in capital is credited, all right? Now we have our cash account. our cash account is reducing money. Okay, this is an asset. So money is going out of the business, cash is going out, all right? So this is a decrease also, right? They are both decreasing, but this case a decrease in asset, because asset follows a different rule. So a decrease in asset is what? Credited. We follow it. So we are going to be entering in. We already have a cash account, so we're entering in our cash account, and then because we do not have a drawings account, we'll be opening a what? A drawings account. All right. Now for our cash, we'll be crediting on the 14th of February 2011. We have what? Drawings. Okay, drawings of 150 naira. Good. And then let's use here for our drawings account. Okay, now for our drawings account, we have to write the heading. Is something we must be conscious of. The heading of the account that we are opening. So this is our drawings account. We enter on the debit side, right? For a decrease in capital on the 14th of February 2011. Okay, cash was withdrawn for 150 naira. Now at this point, what we're going to be doing is to balance the account. Okay, I'll just show us how to balance the account. But every other transaction, you have to follow this same format. Okay, now in balancing our account, what we do is we check our credit side, we compare the total here to the total on our debit side, right? And then the higher value, all right, we use it to subtract the lesser value, and then we get our balance. Okay, good. So there is nothing here. Okay, so the higher value is 150. We have 150 on the debit side, and then we have 0 on our credit side. Balancing our account means we want to bring it to an agreement. We usually balance at the end of every month. Usually we balance at the end of every month. Okay, so if this is February, that means we are balancing at the end of February, which is what? 28. Okay, or if it's a leap year, then 29, but we're going to be using 28. Okay, to balance up our account. Now this is 0 and this is 150. So our balance, the bigger side is less the smaller side. Okay, and we're having 150. That is our balance will be 150. So at the end of the month, which is 28th February 2011, we are having a balance carried down of 150 on the credit side, which is the lesser side. Okay, our balance goes to the lesser side. Okay, now we have our balance. We have brought these two accounts to agreement, 150. All right, now we are not yet through. Okay, since we have our balance at the beginning of the next month, we have to bring this balance back to recognition, and our next month is what? March. The first day of the next month, 1st of March. So on the 1st of March, now since our carry down is on the credit side, our brought down will be coming to our debit side, right? Now on the 1st of March, we'll be having a balance brought down. Okay, carry down and brought down of the same 150, and then we have balanced our account, right? Now we are going to our sales. Now our sales, there's still nothing here, so I think it will also be easier. What we just do is to sum this and this and this. What we have here is 0. So summing up for the credit side, which will need to be the higher side, we are having 1,600, right? And then for our debit side, we are having nothing. So our balance will be using our higher side to subtract our lower side, and then we'll be having 1,600 naira. So this is going to be standing as our balance value, taking our balance to our lesser side, which is the debit side. Okay, at the end of the month, 28, right? 28 February 2011, balance carry down and error sign. Right, balance carried down here is what? 1,600, such that when we add up, because our balance must be on the same line, right? When we add up, we'll be having 1,600. Now we are through with balancing this. Since our balance carried down was here, our brought down the opposite side. Okay, so on the first day of the next month, on the 1st of March 2011, our balance brought down 1,600. Right, this was our balance brought down. So we are through balancing this account. We are going to the next account to balance. I think this is where we have more work, right? Should we save this for last? Okay, let's balance this quickly. On the 28th of February 2011, we'll be having a balance carry down of 600 naira, right? And then we bring our brought down on the 1st of March 2011, we'll be having a balance brought down 600 naira. Right now, for Mr. Oko, on the 28th of February 2011, we'll be having a balance carry down of 400 naira. Balance of this account. And then on the 1st of March 2011, we have a balance brought down of 400 naira. Okay, now we go to our cash account now. We're going to be summing up for our debit side and our credit side, right? So for our debit, we'll be having 1,200, right? And then for our credit, we are having 750. So our lesser side is our credit side, right? That's where our balance carry down goes. The balance carry down always goes to the lesser side, okay? Now we're going to be subtracting. So we'll be subtracting 750 from 1,200 and we'll be having 450, right? Then we'll be taking it as our balance carry down 450 naira, so that when we add all this, we should be having 1,200, the same amount on the same line, okay? On the same line, 1,200, and we have closed our account. Right now, the next thing to do is our balance brought down. So on the 1st of March 2011, we have a balance brought down, okay? B/D. A balance brought down of how much? 450 naira. The amount that was your balance is always for the carry down and the brought down. All right. Now, so with this, we've come to the end of our ledger account. Okay. Don't forget to like our videos, subscribe to our channel if you haven't, and share our video with as many as you can. We'll see you in our next class. Thank you.